Good day to you wherever you are in the world, and welcome to this Chartered Banker Institute webcast. If you're joining us live today, it is the 1st of December. If you're watching on catch-up, well, it isn't. I'm Bill McCall, and with me today is a panel of experts who will return to a subject we have covered previously in this series: bounce back loans in the UK, and more about that panel in a moment. Now, in the midst of the COVID pandemic, the UK government mobilised liquidity measures of all sorts. Organisations, large and small, sole traders to large multinational enterprises, availed themselves of liquidity being prompted by government inaction. The bounce back loans formed part of that response and deployed funds via the banking system. It was policy made in real time, and we know, looking back, it perhaps wasn't perfect, but would resolve a real challenge that many businesses were facing at that moment in time. Now, here we are sometime later, and we're beginning to see the impact and the outcomes, with some high-profile fraud cases capturing media headlines, with no doubt more to come, and some other success stories besides. Of course, if your home is on fire, do you call the fire brigade or an architect? Well, it's a trick question, because immediacy of response is crucial, and the time for redesign and thinking will follow. Now, I'll be speaking to the panel shortly, and in the course of the next hour, we will get through a fair bit from all sorts of perspectives. If you're watching live and want to ask a question, please add it in the usual way, and we will try and get through those as best we can. Now, sometimes time doesn't allow, and you'll understand that we have a schedule to stick to. If you're watching this on catch-up, you can't ask questions in real time, but you've worked that one out. You're professional bankers. You can do that sort of thing. Now, to our panel, I will make the swiftest of introductions, because such are the biographies of our experts that I could spend the entire time talking of their accomplishments, deeds of daring do, and decades in the banking profession. I also want to spare their blushes, so full details are available online if you want to look later. With us, Mike Conroy is the Director of Commercial Finance at UK Finance, covering the corporate and small medium-sized enterprise markets. A previous long-term banker with HSBC, and by my reckoning, Mike, Midland Bank in the dim and distant. He has also led significant policy issues at the Business Finance Task Force, and has had tours of duty in other interesting areas too. Helen Mackay will be known to many of you, and is a credits assurance and training manager at Lending Crowd, the Edinburgh-based non-bank lender, where she was employee number 1. A fellow of our institute, Helen's career in banking stretches back long enough to remember balancing cash and branch managers, and she sports the Chartered Banker Institute tartan proudly as a scarf in today's webcast. Richard Bearman is Managing Director of the British Business Bank, responsible for the Startup Loans Programme. He was in the white heat of the challenge during the pandemic, leading the COVID-19 emergency bounce back loan scheme, and he has recently set up a financial crime team within the bank. Steve Pateman also joins us. He has a lengthy banking pedigree over, should I say, Steve, 4 decades, moving from executive roles to more recently non-executive director at the Bank of Ireland, where he chairs the REMCO. His wider independent director career is broadening as he becomes a client of banking services rather than a provider, poacher to gamekeeper, or vice versa. We'll let you decide as the jury. Steve is the current president of the Chartered Banker Institute. And Martin McTague is the national chair for the Federation of Small Business, the FSB, having been a member for 2 decades or more. He is a business entrepreneur, an owner and a manager of several businesses, So on the client side of our subject matter today, he leads the policy team as a voice for the FSB to Westminster and Whitehall, and has had experience of lobbying in Europe too. Mike, coming to you first of all, from a banking perspective, where are we currently with bounce back loans in terms of borrowing and repayments? I know there are various dashboards available now through government sources and whatever, but where are we so far as you're concerned?
Well, I think the good news is, Bill, is that the overall picture is better than many commentators expected. But of course, as everyone knows, the loans have still some years to run. But as a reminder for those who might not be close to the data, there was 46.6 billion of bounce back loans lending drawn. So you put that in the context of in years pre-COVID, when SME lending was probably around about 60 billion. You've got an idea of the magnitude, and we have round about 1.5 million of our SMEs, of which we have round about 6 million taking the product. Of that, 4.7 billion has been repaid. So that would suggest that a number of people took bounce back loans as a sort of rainy day money, and have since repaid it back. There's 3.2 billion of outstanding balance of loans in arrears. So that gives you an idea of where we are in terms of overall repayments. But although they're in arrears, they haven't progressed to default. So probably no need for panic just yet on those. Another 1.4 billion where the outstanding balance is defaulted, but the lenders haven't claimed, so they're obviously working with customers. So that's about just under 3% of the value. Another 1.2 billion, which has been settled. So that's paid out to the lenders, under the guarantee agreement. Again, that's around about 2.6% by value. And finally, about 2.6 billion of the outstanding balances, which have been claimed but haven't progressed to settled. So, but as I said at the outset, I think there was a lot of concern over, as bankers, we always be concerned about credit being provided on a literally apply, the money's available. But actually, it looks like a good number of customers are doing their best to keep up the repayments. And of course, just finally, the government did introduce the sort of pay as you grow options, which were designed to sort of have sort of inbuilt forbearance, which the lenders were able to use under the terms of the scheme. And again, that's enabled customers to take advantage of those, and to enable them to adjust their finances accordingly. So I think in summary, it's not too bad.
So the perspective, I suppose, is that if you read the newspaper headlines, they seem to seize upon the difficulties and bad news stories. Steve, having been through the previous financial crisis, the big concern for most banks at that point was robustness of balance sheets and capital adequacies and everything else. With a recession coming and a chunk of these loans still out there with the 7-year repayment time frame, is there enough resilience, do you think, to withstand a substantial level of forbearance or maybe even failure in due course with those particular loans to the sector that we're talking about?
Well, I think the short answer is yes, and there are a number of reasons for that. The first one is that under the government-supported schemes, 80% of those loans is covered by the government, so the bank's exposure is only 20%. But even if you look beyond that, the Bank of England have been conducting stress tests on UK banks and the European banking authorities on European banks since the financial crisis. Those tests are pretty rigorous in terms of the level of capital that effectively they require the banks to hold to still have sufficient capital left at the end of those tests to survive. And those results are published, and they're published every year. And you've seen that every year the main banks in the UK have all passed with pretty good room to spare, and those same tests are done by the second and third tier of banks, so Metro, Shawbrook, Paragon and so on and so forth. They will be doing similar tests, and one would assume that they would pass with the same level of space as their larger peers have done. So I don't think there's a risk that the banks will run out of capital, and I don't think there is a risk that the perceived risk of those banks will be such that they won't be able to access liquidity either. I mean, clearly a recession will exacerbate.
Yeah. So even though the recession is coming, is that still the case in your view? If it's a 1 year to 2 year recession, as the Bank of England is hinting?
I mean, the stress tests that the Bank of England do are way beyond what the economic forecasters are currently predicting for the next 2 years in terms of house price deflation or unemployment or GDP. So look, it's only a model and it's only a series of assumptions, but I think it's the best protection that you can seek. But there will be challenges ahead because a recession presents significant challenges to banks and bank balance sheets, particularly those that are heavily geared to real estate, whether that be commercial real estate or residential real estate. But if you look at the quantum of those stress tests that are done by the central banks, they are severe and significantly severe, and therefore I wouldn't expect to see a repeat of what happened in the financial crisis.
So Helen, given that Lending Crowd is a non-bank lender, what role are you playing in the current climate with that economic uncertainty that we just touched on?
Yeah, I mean, I guess the alternative lenders emerged following the crash in 2008, providing a lifeline to many small businesses. And a lot of lenders in our space set up at that time. Didn't know what to expect, but they were optimistic for the future. And the fact that so many of them are still going shows that there's a demand for alternative lending. This time it's slightly different, and the economy is facing tough times due to record inflation, which is impacting obviously on the cost of living, and many can't afford to pay for basics, or they've got reduced disposable income to spend on leisure, hospitality, and items considered to be a luxury. So the risks have to be managed. We've all evolved as alternative lenders, and a lot of ex-bankers have moved into that field who have experience on how to handle tough economic situations. But the risks have got to be managed in a responsible way to protect both the funders and from SMEs overstretching themselves, because they could be going to multiple lenders. But I guess where we're able to support creditworthy SMEs is that, you know, there's still capital out there to lend to them, to help them support with the growth of their business throughout Britain. I mean, ourselves, we recently experienced a record month of lending, which shows that borrowers with the ability to repay are able to access funding to meet their needs. And they may be, I think, what we have found that SMEs are maybe being a wee bit more cautious, whereas they would have just taken any amount of lending before, but they're now tailoring it more to what they actually need, and it's got to be at the right price or the right terms that suit them. So
if we then sort of take that on, Martin, you're on the other side with your FSP hat on. What do your members convey to you that they're experiencing from the banks that they're active with? What sort of feedback are you getting at the moment from the FSP membership, which, bear in mind, is a significant portion of the UK economy? I mean, not everyone is employing 100,000 people. So there is that vast array of businesses that are really in the bailiwick that we're talking about. What are you hearing and seeing at the moment?
Yeah, I mean, it's easy to forget that SMEs in the UK employ 16 million people, and they're over 50% of the economy. And what they're telling us now is they're entering into quite a new phase, post-COVID phase, where Availability of credit started to become much more difficult. The refusal rates are much higher. Certainly in some sectors, retail, hospitality and leisure are finding it very difficult to get investment. There's very little appetite for investment in new projects and infrastructure. They're mostly the people looking for credit are looking for working capital, but they're also telling us the price is increasing. So the cost of that debt is increasing quite significantly. And you know, there are some really big challenges coming up over the horizon. You know, you've got they've been encouraged to invest in net zero opportunities. There is decarbonizing their businesses, which could be expensive. So there's a lot of demand on investment requirements. Plus, the other thing is, if you look at working capital requirements, in the UK, we have a terrible culture of poor payment practices. Very, very poor payment from big corporates to small businesses. And that is doubling the working capital that the average small business needs to keep just so that they can cover these poor payments.
What do you think drives that? I mean, because that seems to be ingrained. This is not new news to us that payments are slow. I mean, various governments of different hue and cry have tried to remove what they describe as red tape. I'm not sure I've ever seen red tape. Well, certainly not in the last 25 years. Yeah. Physical red tape. What do you think is the driver there? Because it seems to be a long-term problem.
Yeah, I think it's a cultural problem in the UK. I mean, essentially, there are two types of late payers or slow payers. There's the ones that set out with a sort of malign intent that do not think it's sensible to borrow money when they can use other people's money for nothing, particularly their supply chain. And then there's the second group who are frankly quite useless. They have really poor systems. They are very clunky. But they don't invest in any of those systems because there isn't any sort of pressure on them to improve their payment practices because there's this poor culture. Now, what we're saying to government is, at the moment, there isn't an accountable person within the organization, somebody who has to stand up and say, well, this was our payment practice last year, and this is what we're doing to try and improve it. There is nobody that's in that position. They don't have to make a statement in their annual account. So it's a problem.
So is that almost like a designated, like a money laundering reporting officer type role? Exactly, that you think it should be more? Yeah.
Yeah, what we're suggesting, probably the obvious candidate would be the chair of the audit committee. They would be in a position where they would both gather the information, put it in the annual report, and be available to answer questions about it. And then you've got somebody that needs to stand up and be accountable for what has happened.
So, in Companies Act law, boards and directors have duties of care and responsibilities to shareholders and creditors and everything else. You would think that there is enough legislation in there to make people behave properly, if I could use that as a phrase. Is that not fair?
No, it's not working. And the message I've been trying to present to big corporates is, look, you know, your supply chain is an essential part of what makes you a successful business. And if you're going to abuse it, you end up with the poorest suppliers. You end up with the ones who probably don't have any option. They have to trade with you. And you'll end up with a very volatile and you'll lack resilience. So if you want to put it in shareholder interest terms, they should be trying to treat their supply chain better, because in the end, it will make a more successful business.
So from that malign position, and thank you, I've jotted down that there are 3 Ds that businesses are facing: decarbonisation, digitalisation, which is the whole sort of online thing, and the third is the decentralisation with hybrid working and everything else. So those 3 Ds are quite a challenge, I suppose, for organisations to be dealing with. Richard, I know that you're spending a lot of your time now being concerned about increased fraud and what's going on in that arena. What is currently keeping you awake so far as that's concerned?
So I think it's fair to say fraud has been a kind of a concern and something we've been focused on throughout the scheme's life. It was right from the outset. The very nature of the scheme meant that we had to be sort of much more thoughtful than potentially elsewhere. And I think what keeps me awake, and I mean nothing keeps me awake at night. I think what we're moving to now though is the sort of the thinking around recovery activity, working with our lenders and then the bounce back loan scheme to make sure that clearly not just what they're doing within the guarantee agreement, within their sort of contractual agreement with us, but actually what else can be done. I think the scheme is closed, the scheme is finished. Yeah. The level of fraud that's being identified is lower than some of the worst fears, as Mike's already sort of highlighted on the sort of the wider sort of loss rates. But we're sort of very much about, this is public money and thinking about how do we minimise the fraud losses. I think the other part of it though is also the sort of the counterpoint to make sure we're also being fair to the businesses, because I think it's quite important that you don't swing too far the other way as well. I think it's important that where action is taken, where recovery activity is taken, where potentially sort of enforcement action is taken, it's focused in the right areas, and that we don't sort of impact genuine businesses that might have made a mistake or something like that. So I think finding the right balance is important, but fundamentally I think that recovery part is quite key, and we've got, I think, really good engagement with our lenders. There's a good constant good dialogue with them, and ideas. The lenders are coming up with ideas. It's a scheme that's it is a unique scheme. There's sort of peculiarities about back loans you don't get elsewhere, and I think it's quite positive that a number of lenders come forward and think, actually, we could do this, we could try this differently, and so I think that's the key thing for us to focus on at the moment.
So when you were in as I described at the outset, the white heat of this being created with pressure from government to just simply deploy money through the banks, and then there was the wrangling around security and would it be this, would it be that, and everything else. What do you recall as the pulse beat within your organisation and your team at that point in time? And you're allowed to say that you wanted to lie in a darkened room, I suppose. But just describe for our audience today where the competing pressures were and what you were trying to achieve versus, say, what we see today.
I think it's why I look back on it. Don't get me wrong, with a scheme like this, when there is such potential risk and there's such big figures of public money at stake, and you can't get complacent about the levels of fraud and things like that. You always have to have that kind of caveat. But also, I do look back at that period with real pride of the team I worked with, because it was like for everybody at that period of time in our industry, it was really difficult. We didn't have a team sort of sitting there ready to launch this scheme. We were seconding and moving people from all over the bank to come and work and focus on it. Obviously people at the time who themselves worried about what was going on, worried about their own family members, etc. So it was hugely pressured time. But I think at the heart of it, it was to try and make sure that we delivered the policy intention, trying to make sure we were kind of doing what was ultimately instructed. And I think that kind of the three elements there were about speed to deliver the scheme. So, working with UK Finance and others to sort of make sure the scheme was not just delivered, but delivered quickly, because back then, I think Oliver Martin sort of calling it, the view was that small businesses had weeks, not months left to survive. So it was around getting a scheme up and running quickly, but then also once the scheme was up and running, making sure the money got out the door quickly as well. And so that meant the removal of certain checks that would be put in place in normal circumstances, particularly around things like affordability. So it was around trying to make sure that we understood those policy intentions. And then with that comes additional risk. And so as soon as the schemes launched, it was then, okay, what controls can we put in place to minimise the risk, to minimise the potential fraud and other risks, but still keeping in line with those core policy intentions. So it was a pretty hectic time, but one that, with all the challenges, I still look back on with real pride. And I think the recent evaluation we've had done, which is independent evaluation done by Ipsos Mori for us, they're talking about up to sort of 500,000 plus businesses surviving as a result. And I think there's also another part of it that I look back on with positivity, which is there's a whole chunk of businesses that survived. But I think there's also another chunk of businesses that, because they had some money in the bank, because, as Mike said, they had some money that perhaps they didn't need immediately, could potentially carry on making decisions, could potentially carry on investing or take on a new customer along the way. And they might not have been in the survival category, but they definitely benefited from the scheme. So yeah, it was challenging, difficult, and still things that could have been done differently, of course, but something I still look back at and continue to look at with pride and seeing some real benefits from the scheme.
We can only look at the pace with which the scheme was created, refined, and rolled out. Mike, the numbers are large, and there's a heightened anticipation from the public, because it is public money at the end of the day that's being used to sort of underwrite the position. The wider economy, though, is impacted by that. Are you seeing, or are you concerned, or where is your thinking at the moment around recovery of those loans? You gave some very interesting statistics at the top of the programme around where defaults were sitting and where rescheduling, etc., and forbearance. What worries you looking ahead 12 months, given what we've said about recessionary challenges?
Well, I think, Bill, an important point to bear in mind, and it goes back to what Richard was saying about what was the purpose of the scheme in the first place, and it was to help these SMEs survive. And Martin again, will know that the difficulty a lot of his members were under these very difficult terms. So it would be sort of very counterintuitive if lenders were to then start getting very heavy-handed the moment someone gets into difficulty or was to miss a payment. So I think everyone sort of recognizes their responsibilities aren't just in getting the money out the door, but it obviously helping these businesses that have bounced back loan debt to manage their payments. And of course that is the reason why the sort of help to grow elements were sort of built in recognition that in some cases it was appropriate to put these loans out to say 10 years because it would give people more chance of repaying it. And of course that's good for the taxpayer because if the lender simply called in the loan and claimed on the guarantee, well there's no money there for the taxpayer. Much better if people can be obtain some sort of forbearance and work with them to enable it to be repaid. So the other things to bear in mind, that lenders are at the end of the day responsible for collecting the the money in the repayments and recovering loans that get into default. Richard will remember well, I'm sure, that probably about 2 years ago now, we worked very closely with the British Business Bank and HM Treasury to create some quite detailed sort of recovery principles, and really they sort of set out the expectations and very helpful to lenders who were very much part of those creations in terms of how banks needed to behave and what the best way to treat customers was. And then of course in addition to that we have their own practices, lending standards, and of course wider sort of industry regulations. So all those are in place. Each lender is able to follow their own sort of business as usual approach. But of course, in doing so, they've got to make sure they don't contravene the scheme principles. And of course, those approaches to recovery can vary, across the industry. So some, for example, might make use of debt collection agencies, and some may not. But even in the use of debt collection agencies, the onus is very much on the lenders to make sure that the debt collection agencies operate and perform in an appropriate manner. So again, that's very much sort of baked into the process. So I think it is really important. Regulators have written to lenders, just more generally about encouraging a focus on doing the right thing and treating customers fairly, and that's very much baked into this overall approach. But again, the groups that we set up that were designed to get the scheme up and running. We run today. We speak in forums regularly with the BBB and government. Because it obviously keeping a very close eye on how these how this approach develops. But at the moment, as I say, very much at the forefront of making sure that everyone's treated as well as it can be, accepting that there will be some losses associated with the scheme, but it's in everyone's interest to do the best things for these SME customers.
Martin, I'll come to you in a moment, but Steve, wearing a banking hat, is the profession suitably covered in terms of the skills and the professionalism that's needed by the banks to deliver on those principles? Or is there a risk, because this is the risk that would be asked by the general public, that in the face of significant loss, the principles will be moved to the side and the recovery machine will just kick into action? Is the profession really ready to deal with that, Steve, in your view?
It's a good question, and I think the balancing act as we go into the next 2 to 3 years is going to be more tricky, because you have gone through a period of time where there have been significant government interventions to support small businesses. And I absolutely agree with Richard that a lot of good things were done in a very short period of time to help small businesses come through a very difficult phase. And it's easy to criticize the things that perhaps didn't go right, and rather than focus on the things that did. But in the next chapter, it will be, I think, a very difficult tightrope to walk in terms of how would you support a business that has got into difficulties with a government-backed loan, and where do you draw the lines around whether that business can survive a recession and come out the other side, and what support does it need to do so? So I think it is more difficult because of the nature of the loans, and the fact that there is this widely held knowledge that it's a 80% government problem and a 20% bank problem. So if the bank is difficult for the 20%, then it doesn't seem to sort of land well. But at the same time, the obligation is on the banks to professionally manage that book with appropriate responsibility and due consideration to ensure that the loans are recovered. My instinct says that if we get into a deep and very difficult recession, there will probably need to be an extension of the bounce back loans or some framework to help the viable businesses come out the other side. Because if there isn't, then I do think the consequences for recovery will be marked. So my instinct is that if the recession is deep, there will need to be some other form of government support for a lot of these businesses. It may be a derivative of the bounce back loan scheme. It may be something different. I don't know. But I do think that if you look through this and say, well, you want the recovery to be sustainable and in the words of the Chancellor, to be quick, then I think helping businesses just a little bit more to come out the other side is probably the right answer.
Yeah. So Helen, I'll come to you in a moment to think about skills for those professionals working in banking and what they might need. But Martin, you've heard the sort of industry view of things. From your membership perspective, is that what you're seeing in actuality, or are there creaks in the floorboards at the moment already?
Well, it's interesting. There's about roughly 1.5 million businesses use bounce back loans, and our evidence seems to suggest they're roughly split into thirds. So there's about 500,000 that would have gone almost immediately if bounce back loans hadn't been around. And when you think of what that would have cost to the British economy, it was colossal. The other 500,000, I would say, were the ones that I think Mike and Richard were talking about, that would have gone into some sort of deep freeze and would have not being able to invest would have not come out of this in good shape. And then there's probably about 500,000 that frankly took the money as sort of rainy day money and didn't really need it at the time. Now, a lot of those guys are paying it back, as Mike suggested. But the situation now is we're about to enter a recession that some estimates could last a couple of years. Now, under those circumstances, they've got depressed demand, they've got a shortage of cash, increasing costs. I think, Steve was right in saying that it isn't going to be business as usual. There is going to have to be some sort of government intervention. And I know the government use this phrase, corporate welfare, the doors are shut. We're not doing any more of this kind of stuff. But the reality is paying for the failure of hundreds of thousands of businesses and the damage it does the economy is so severe, they may have to. When you look back at the last recession in 08, 09, 85% of all the jobs created as a result of that, in trying to come out of that recession, were created by SMEs. So recovery is nearly always led by SMEs. So if you really are serious about trying to shorten this recession, or at least make sure that you don't come out of it with too much damage, that's where you've got to focus your attention.
Yeah, and we've got 1.5 million unemployed. There's about 5 million people that I would describe as underemployed. Yeah. They're working, but they're in some form of universal credit or benefit or whatever. And those are the very entrepreneurs that we probably need to stimulate growth. Helen, to think about it now, as with your Fellow of the Institute hat on, what sort of education and training do you think bankers are going to need over the course of this next short period and beyond, perhaps?
Okay, so I see this sort of fitting into several categories, to be honest. And it's not just bankers. I would say that anybody that's involved in SME lending need a lot of these skills, including the people in my sector. So when you look at origination, you need to have skilled bankers that understand financial accounts, how businesses operate, so that they can advise these businesses again, like going back maybe 10, 15 years ago, help them to identify how they can make savings. And I think Joseph Healy mentioned this in one of the previous episodes in the series. He felt that we should all get back to basics. Also, from an origination point of view, fraud awareness is really important to be able to identify suspicious activity and common signs, trying to be ahead of the fraudsters, I guess. They're becoming more and more sophisticated in their methods, and it's very hard to keep on top of them. Then, when it comes to managing the book and recoveries, then you've got to have the traditional listening skills, understanding what the customer's business is actually doing, risks to both the lender and the customer. And I don't know, should all credit and recovery specialists hold a certificate in commercial lending? Maybe even the RMs need to go back to that. I know there's a few out there that do have it. And then when it comes to the recovery process, to make sure they're aware of the legislation to protect their employer as well as their customer, following TCF rules and doing things right to avoid reputational damage in general. And then, of course, the big thing that emerged out of COVID was the vulnerable customer training to understand when there's genuine cases and to ensure that these people are being treated appropriately. I think the FCA have raised their concerns, and I think Mike touched on that. And this has got a more of an increase in focus within banking, but the Institute again has been really good in helping support individuals with that, with the vulnerable customers on your online modules, and there was the customers in crisis as well. And then if we look to the future, and just touching on what Martin said about green finance, sustainable finance, the things that small businesses are going to have to adopt to become net zero. How can bankers help to support their SMEs in making those transitions? I think they also need to understand what responsible banking is. And, again, the Institute's doing a fantastic job with their qualifications in green sustainable finance, and obviously the recent launch of the Principles for Responsible Banking Academy, which has got something for all levels of bankers. And then the final thing, we've got to think about individuals, the resilience that people need. And our bankers need to be resilient during difficult times to help support their customers while dealing with maybe their own personal situations. And I think COVID helped to highlight mental health issues and challenges that individuals were facing on a daily basis in their personal lives. But this hasn't necessarily gone away, and it could be, I suppose, to quote somebody that I was speaking to, it could be quite soul destroying, constantly dealing with the same issues when speaking to customers. And especially bankers in the front line need support to deal with this. And it may not be losing loved ones to COVID this time or juggling homeschooling, but they may have to manage their finances in a very tight manner, the having to cope with just like many of their customers. And the Institute, again, has provided great support over recent years with articles and webinars focusing on the well-being of its members. So I think that's really important to make sure that the individuals in the industry are being protected and they can build up enough skills to help, not just deal with their own personal stuff, but they can maybe then help their own customers with that. And I suppose there's so much technology out there now that, that can be put to a better use to help support the future of banking.
I'll come back to technology in a moment, but dare we say that professional bankers are humans too, is a point. I'm glad you mentioned Joseph Healy. He joined us on one of the earlier webcasts on this subject. Joseph is one of the CEOs of Judo Bank in Australia, and I know he will be particular. He's a real football fan. I think he played for the Scottish football team. Yes, we do have one for those watching. At a very junior level before he emigrated to Australia. And I know that he has been involved with the Australian Football Association and will be delighted they've proceeded through the group stage into the next stage. So Joseph, I know you'll be watching and catch up at a later time. We wish you particularly well on that journey from there. Richard, coming back to you for a moment. Hindsight is a wonderful thing, although it can always be a curse as well. Steve positioned a point where government, and that would ultimately be thrown over to your organisation, to moderate or perhaps modify or tweak the bounce back loan situation to cope with an oncoming onslaught of a recession that is generally accepted as coming and here. If you were having to tweak and redesign or reconfigure or whatever we want to use the word, what would you be doing differently this time, given that you had to move at breakneck speed last time to create something that was almost a blank piece of paper? What do you think might be coming down the line at you?
So there's a lot of work being done, as you can imagine, sort of across our organisation, across government, about sort of lesson learned and just thinking about what could be done differently next time if you're in a similar situation. Just a couple of things I think before I just go into a few of those is, can't help but promote startup loans. I think one of the things we're saying about sort of recession and how important sort of new business will be. I also look after that, and I think it's important to say there is support. There's a support infrastructure there for people at that early stage of their business, both in terms of funding when they can't access funding through the normal routes, and also support. but also I think sort of looking back, actually the pay-as-you-grow scheme, which was brought in once Bounce Back Loan was up and running, was something that on reflection, it's something perhaps you'd have built in from the outset to give people even more confidence when they entered into the scheme. And just to remind anyone who's not quite sure, it's not forbearance, but it's similar to forbearance, but it's a structured way of saying that the Bounce Back Loan recipients could get could extend to the 10 years. They could take up to 18 months interest only, or they could take an additional capital and interest holiday. And I think having that embedded up front would have probably given people even more confidence, as I say, that they had the flexibility. And it's also well over half of the applicants or the recipients of Bounce Back Loans haven't used a pay-as-you-go option. So I actually also hope that we can keep promoting that. It's something they can use throughout the life of the scheme. And actually, as we head into this next year or two of challenges, actually having that ability to take those options for those that haven't done, I think could be, again, a sort of a real sort of lifeline through this extended period. Other areas I think could look back and say, I think data has been an interesting thing. I mean, there's a lot of data. We collect a lot of data. There's a lot of data that the lenders provide to us. But I think, again, you sort of learn from that. I think we probably could be better about how we use that. I think we're pretty good now, but how we use it, and actually be more specific with our lenders about exactly what's needed, and actually potentially build that into the contract. Because I think yes, it was built quickly, but if you'd had a better data infrastructure, you probably could have understood your trends and been able to sort of make decisions perhaps a little bit earlier down the journey. And the final thing I think that is not something I'll change, but I think it's definitely something that I've learned, and we've collectively learned, and I feel puts us in a better position should you need to do something again. It's actually both sort of within government, but then probably more importantly across organisations, how organisations have worked together. And I think particularly with UK Finance, where we do run regular meetings with monthly meetings on the topics of fraud and recoveries, and that wasn't happening beforehand. But I think if you run into another sort of crisis situation, the fact that you've got forums and infrastructure and agreements in place would make it easier to sort of get things up and running, and particularly for us to get that feedback from the lenders to make the schemes that much better.
So plenty of learnings, because this is a refining process, as opposed to throwing brickbats at those who had to create something at rapid speed that had never been looked at before to deploy in the market. We talked briefly earlier about the digitization and the digital world that we had to move in pretty much through the COVID position, and the decentralization. It's hard to forget that many of the banks and organizations that we all know, and many of our members are employees of and work with, were working from a dispersed model that had never ever been seen in the modern economy. We had banks that were running credit positions with people in different time zones, not in offices, working from home and doing all of those things. So when the book is written on all of that, I do hope that the resilience and the adaptability of the professionals in the sector is brought to the fore. But there is a real concern, I suppose, that there is a technological gap in banking, because we do know that some of the banks still have ancient mainframes. They've got some real old systems that don't talk to new systems, lots of technical sticky tape and gaffer tape making things happen, and mistakes happen. I mean, there was an example recently of a large bank miscalculating interest payments on loans and then having to write that off. Mike, Steve, coming to you in turn, is that sort of, I daren't call it an error because it just looks like a mess up. Is that a one-off, or do you think that sort of technological gap is going to be something that has happened in other banks too, and we just don't know yet, and might happen again? Mike, would you take a view on that
Yeah, sure. And I think with regard to the the incident that was reported, it was actually sort of misreported because it was there was reference there to bounce back loans, and it actually wasn't to do with bounce back loans at all, and only relatively small numbers of customers. But that aside, I think you're right. I mean, as you say, a lot of well-established household names have got legacy systems, as everybody knows, and it is a challenge to keep pace with emerging technologies. I mean, I remember, as you said, old days in Midland Bank, and there was certainly no internet, and in fact, in those days we didn't even do mortgages. We invited people to go down the road and speak to a building society. So the world's in a very, very different place. We've got obviously digital banks that are have you would imagine state-of-the-art sort of technology. So I think it is a real challenge in terms of resources, and I know a lot of banks are challenged by the regulatory environment, where in terms of IT spend and systems change, if you want to be top of the tree, it's got to be ticking in the regulatory box. And if it's a nice thing in terms of your CRM systems or something else, customer journeys, it's harder to get the resource. So I think it's an absolute challenge for everyone. Going to slightly to the wider question of and just picking up on Richard's point about lessons learned and planning ahead. I mean, I think there may be a case for thinking, well, I think everyone involved with setting up bounce back loans and other government schemes did an absolute tremendous job, and I hope history judges it that way. But there is probably a question of whether government should plan ahead and have if you like, a sort of a fast response solution which they're able to deploy at short notice. And then, as you're saying, thinking, well, if you're going to do it through delivery partners, can we make sure the delivery partners know that when the emergency button
they know it's coming,
they get an idea what the what the call to arms actually is. And just finally, maybe on the fraud point. There are things we could do today, which I think would help, and that would include reforms to Companies House, where it's frankly far too easy these days to go and register a company with very little due diligence. And I think there's a role that Companies House could play in making sure that when they say that someone is now registered at Companies House, a certain degree of checks and due diligence have been undertaken.
So Steve, I'll come to you in a moment, but there is well, there certainly are a couple of questions coming in from the live audience, and I'll get to those in a moment. Steve, are you worried about the technological ability of banks to deal with what's coming at them?
I think Mike has summarised it fairly well. I mean, technology is a massive challenge, and the bigger the bank, the bigger the challenge, because you've got more legacy infrastructure to try and weld into some of the modern technologies, and oddly enough, different banks design themselves in a different way in terms of their infrastructure and their product setup. And therefore, whilst it may seem very simple that you have a set of bounce back loans or C-bills that look identical to all intents and purposes, the way that they're then manufactured in each individual bank will be different. And there'll be a whole range of issues around how they deliver them. But I think the technology challenge for banks has been with us for many years and will be with us for many years to come. And I don't think it's peculiar to bounce back loans or C-bills or any of this. It's a macro issue that isn't going to go away anytime quickly.
So I've got 4 rapid questions I'm going to get us to the end of the session with. It can be yes or no, and if you think you know the answer, you can jump in. So it's almost like one of those quasi game shows. So are you ready? Fingers on buzzers and all that stuff. In seriousness, though, the National Investigation Service and the National Crime Agency, are they suitably resourced to deal with the £6 or £7 billion worth of fraud, do we think? Or is that something that requires attention? Don't all rush at once. But it's an open question, I suppose, and the answer will be that they're never adequately covered, I suppose. Also, Richard, were you approached by other countries about what you were doing, or did you approach other countries about what you were doing to trying to achieve? Was there any supranational collaboration that went on during the design of the scheme?
because of the sort of the time frame, not formally but informally, definitely both during that design phase and then subsequently. So yeah, we're sort of in both directions, folks sort of looking and trying to understand what was working and vice versa. So yes, definitely.
And we also have a question around what happens when you're out of runway around the PAYG position. You know, when you get to the end of that line, what happens? Martin, question for you: what is your organisation's view on the zombie companies? I think we alluded to that earlier. We didn't call them zombies; we called them something a bit more polite. But a growing threat to have those organisations that are simply marking time.
Yeah, I mean, there obviously was a percentage of firms that coming into COVID were probably close to extinction then, and maybe have been put on life support. I think that's overstated in many cases. You know, obviously there is always a churn of those kind of businesses, but I think that can sometimes be used as an excuse for not supporting decent businesses who've got a decent opportunity to turn themselves around and provide real contribution to the economy. So my main point would be, don't overstate it.
And Bill, I think that's a really important point, because it's so easy to categorize businesses as a means to, as a way of justifying what you're about, the decision you're going to take. And I've seen it happen so many times. And I think it comes back to a point that Helen made, which is, I think the danger, if you try and train people to deal with a situation, you create very narrow tram lines, and those tram lines become the way to deal with things. And the reality is every business you touch and see is different, has different challenges and different requirements. So you need to find a way to establish a series of principles by which you will operate, but to be able to exercise those principles as appropriate to the situation you find in front of you. And I find the emergence of this phrase "zombie business" has been, I think, is fundamentally unhelpful in trying to find constructive solutions for businesses.
Yeah, we will see it in the media, no doubt, more readily over the course of the next while. But good credit worthiness generally can attract credit is the truism, I suspect. And if the answer is no, there's usually a pretty good reason for it, but understood. We are fast approaching the end of the allotted time on this session. And once again, the time has flown, which is a good sign, I think. No tumbleweed with this panelist group. So to the panelists, our heartfelt thanks for bringing your expertise to this virtual table and advancing our attendees' thinking today. So to all of you, thank you. My thanks to the team at the Chartered Banker Institute, Christy and Matthew and Heather, for making this event happen. And to you, those of you who are our live audience and have been asking questions, or for those of you tuning in at a later date, thank you very much for doing so. We are your institute and we very much value you being part of it. If you are one of our 30,000 members around the globe, remember to log this as part of your CPD records online, and do it now before you get tied up doing something else and then you forget, because it is really important to do so. And if you're one of our students internationally and coming up to examination time soon, the very best of fortune in your endeavours to achieve our chartered status, the gold standard in banking professional qualifications, as far as we're concerned. Now, don't forget to tune into the grand final of Young Banker of the Year. That will be live for the first time in a few years from the Mansion House in the heart of the City of London. And our very best wishes to the 4 finalists. The 4 of you are wonderful people. Just enjoy the moment. The opportunity to speak in the Mansion House is something quite special. And as the end of the calendar year is in sight, I wish those of you who need it season's greetings, happy holidays. And here's hoping that we as bankers have a very prosperous 2023. So until next time, from me, Bill McCall, and a panelist of experts, thank you for tuning in. Goodbye.